Particularly 2025 turned out to be a year where you saw the volatility index go up significantly. It has kind of created a platform for or a base for us to now look ahead into 26 and 27, especially at a time when we are also seeing earnings growth revival coming back. Growth lever are shifting now. The driver or the lever will move from a broader government-led capex to a more consumption-led. And at some point, we also expect the private capex also to kind of, chug along.
Contribution of exports to GDP is coming down. I understand we are growing on PLI, we are growing on electronic manufacturing.
Yeah.
So do you think moving from now export-import can be a better story?
We are at that inflection point where we will see India becoming a good manufacturing hub for the global players, and we also becoming a more exporting country.
If you look at 5 years average PE of large cap, mid cap, small cap, all three, they are at least 20% premium to their 10 years average. So is it a bubble or it's a tectonic shift?
But one thing I clearly do bifurcate between my fund when I am trying to build the portfolio is that how much is the compounder and how much is the alpha.
As we are witnessing new year to start to unfold, how should one invest the money? Hello everybody, welcome to another episode of My Money Panda with wealthy Nivesh. Wish you a great and prosperous new year ahead. And with me today I have got Meeta Shetty, who is fund manager with Tata Mutual Fund, managing Tata Digital Fund, Tata India Innovation Fund and Tata Multi-Cap Fund. Welcome Meeta, welcome to the episode.
Thank you so much, Ankit. Thanks for having me.
Great. So Meeta, if we could, because it's the first episode of the new year, so if we can start with, how you have seen markets in last 1 year, how markets have moved in last 1 year.
Right. So, last 1 year, of course, was not a great year in terms of, and particularly if I look at the last 5 years, we've seen some decent returns made on the markets. But particularly 2025 turned out to be a year where you saw the volatility index go up significantly. And although point to point, we have seen some gains on the broader indices like a Nifty or maybe a Nifty 500. But if you actually look at the breadth of the market, it's actually been a very, very, very extremely volatile year. So I think like the previous years, this year was not a great year, but then at the same time, it has kind of created a platform for or a base for us to now look ahead into 26 and 27, especially at a time when we are also seeing earnings growth revival coming back. So I would say 2025 turned out to be a more of a, a pause. Yeah, more of a pause and reflect kind of a year. And now probably things are looking more brighter as we look ahead.
So what you are trying to say is that along with the sombering of valuations, earnings growth will also help in getting better returns in coming year.
Yeah, absolutely. So if you look at the earnings growth from fiscal 21 to fiscal 24, we've actually seen double-digit growth, a healthy double-digit growth in Nifty EPS. But if you look at 25 and now 26, which is going to end in March, the EPS growth has actually come off meaningfully. We've seen only a single-digit growth coming in. And at a point of time when Indian markets had rallied, the valuations were looking higher. At the same time, earnings growth coming off to a mid-single-digit kind of number, it clearly told us that, markets might pause or maybe correct. The good part is we've time corrected and we've not seen absolute correction at a broader level. So now when I look ahead, we are looking at that double-digit growth coming back in fiscal 27 and as well as in 28.
So what are some of the developments which will, simulate this growth on the earnings side? So I understand one can be GST 2.0, then other reforms by the government. What are the developments that you see which can prod this growth to be higher?
Right. So let me step back a little and give you a little more nuanced view of what I think or what we've seen. If you think of the EPS growth, which was actually very good in fiscal 21 to 24, a lot of that had to do with the kind of government capex that we were seeing. We've seen our, at a country level, our capex, the infra capex or the central government capex number, as we call out, actually went up significantly in those years. and that kind of had a multiplier effect on the economy, and that's where we saw growth coming very strong. That number has started now growing, but growing at a far smaller pace than it was, and hence that growth lever are shifting now. Particularly in the last 6 months, if you look at what government has tried to do, is that they've given a lot of tax rebates in form of direct tax, in terms of indirect tax, GST changes. We will also have the pay commission revision coming in fiscal 27. All of that would mean that now the driver or the lever will move from a broader government-led capex to a more consumption-led. And at some point, we also expect the private capex also to kind of chug along. So I think the levers are moving, and now that the growth that we're talking about is going to come in 27 and 28, fiscal 27, 28, will be more driven by these two pillars, the private capex and the consumption.
So you mentioned private capex and consumption. So if we look at other two parts, which is export import
Yeah.
and government capex. So four pillars like government capex, private capex, export import, and consumption.
Right.
Now all throughout India always has been private consumption story. Government capex has been there because government has to win elections and they have to spend money on infra, on freebies, etc., etc. But if you look at export import, even if we discount recent America tariff war, etc., exports have not grown as much in last 10 years. In fact, if my memory serves me right, contribution of exports to GDP is coming down in percentage terms. So how do you see that number? So I understand we are growing on PLI, we are growing on electronic manufacturing.
Yeah.
So do you think moving from now export import can be a better story?
So I think that, look, there is a lot of rhetoric on the geopolitical side, especially given the trade deal where we are. So I think that a lot will depend on how that moves, at least in the very near term. But I think if I have to call out, say, a 5 year out, or slightly even longer, then I think that we are at that inflection point where we will see India becoming a good manufacturing hub for the global players, and we also becoming a more exporting country. So I think that those ingredients are starting to get in place. But obviously, as I said, there is a lot happening on the geopolitical side as well right now. So we have to see how quickly we can resolve that and we can get on to that journey of where we want to be. But I'm not very negative in terms of whether we will reach there or no. I think it's just a matter of time. It might get delayed because of what's happening around us, but I'm sure we are on the right trajectory.
So just to add on to some numbers to what you said, $50 billion of export by Apple.
Yeah.
Cumulatively. $17 billion by Samsung.
Yeah.
We are looking at a situation where in a year's time probably we'll reach $1 trillion export if we include services and merchandise both. So when it comes to export import, there is positive side, there is con side. The con side is that your dependence on external countries, geopolitics, etc. becomes higher.
Yeah.
And for long we have been listening to this thing that because India was not that much part of the global supply chains, so we had a buffer to global risk. So do you think in coming years India will have higher global risk?
So if you look, yes, the dependency is there. There's no denial for that. But if you look at what government has been trying to do, look at the example of solar modules. Initially, only the solar, the end, or what do you say, even in electronics for that matter, only the end assembly part was what was actually given incentives. Now that is moving one or a couple of notches lower. You need to have a certain percentage of components which have to be made in India. You have that in solar, you would have that in electronics as we go with time. So that would ensure that, and if we continue on that trajectory, that will ensure that our dependency gets lower with time, and that risk, I don't think it will completely get nullified, but that at least the quantum of risk that we are sitting on it today versus what probably we will be 5 years down the line will be significantly lower in my sense.
Okay. And I'll supplement it with another fact. So the biggest hang right now is a US trade war.
Yeah.
Correct? And markets, when people ask why markets are going down, people start citing tariff war with the US. People say it's bad for economy and blah, blah, blah. If you look at numbers, the exposure to America on both export-import side is within 2-3% of our GDP.
Yeah.
So even if we discount 50%, that 50% will be the effect on our export, that will be less than 1% of the GDP.
Right.
So that means instead of growing at maybe at 7%, we'll be growing at 6%. But it becomes such a big hang on the psyche of markets, of participants, of economy, that its effect is much more than its real impact on economy, on numbers.
While on mathematically speaking, what you're saying is right, but see, we are talking about the largest, consumer market of the world. Second, we also have our decent services exposure, into that
Okay.
country. So there can be some rub-off effects
Spillover.
if, we would not have a more amicable kind of solution to this. So, and I'm sure both the governments want to do it. So let's see how it unfolds.
Let's hope for the
But
best.
let's hope for the best.
So if we look at Wealthy Nivesh, we look at markets in three buckets: large, mid, and small cap.
Yeah.
Correct. And we look at valuation. So these are two pillars on which all our recommendation on our research is based. Now, if we look at 5 years average PE of large cap, mid cap, small cap, all three, they're at least 20% premium to their 10 years average. So is it a bubble or it's a tectonic shift?
Look, Ankit, I have a slightly different way of looking at, large, mid, small. I generally, as a fund manager, I don't look into these buckets as the market cap criteria buckets. And I have reasons for that, right? One, if you just talk about large cap and when you say that historically versus today, numbers are looking better, lower, etc. But there are, like, certain section of that within large cap, if you remove the banks, then actually the multiples are not as attractive as
Yes.
it must be. So what I'm trying to say is that it's more stock specific. It's not a
Sector
bucket.
specific also.
Similarly, if you come to small cap, now, at the desk that I sit and the money that I manage, even if I take a cutoff of 7,000 crores as a market cap cutoff, below which I may not want to invest because of the liquidity concerns, even at 7,000 crore as a cutoff, starting from 30 or 1,000 crore that the small cap starts today, there are over 400 stocks that I can invest into. And not all of them are very expensive. So again, it gets onto a more stock specific kind of
Bottoms approach.
up approach. And that's how I usually think and I usually deploy for, the money or the asset that I manage. So for me, I never look at these buckets as they are. Well, to some extent, I would say that for mid cap, it might still be relevant what you're saying, because the mid cap exposure, the universe is very limited. You have just about 150 stocks, and the investable are just about maybe 60-70% of them. Keeping the quality checks, etc., in concern. So there, yes, some crowding has happened because the way mid cap as a category has been receiving, inflows, but not for the large and small. I mean, I don't think in those buckets when I am actually looking to invest into these, areas.
So, Meeta, when we look at last 16 months, last 16 months returns have been zero.
Yeah.
For large cap and for broader markets, they have been slightly negative.
Yeah.
So, as a fund manager, how do you manage such kind of movements? And I'll tell you how we worked, how we did it.
Yeah.
It becomes easier for us because we can take heavy cash positions, but a fund manager can't take heavy cash positions.
True.
So, what we did a staggered exposure. We suggested to our clients that you take a staggered exposure. That on 1st October, whatever money you bring in, we'll put it into liquid, and from liquid, it will go through STP weekly, 5 months, 6 months, or even 7-8 months, and it worked well. So people got 10-12% kind of alpha as compared to 0% returns as of now. Similarly, we suggested them to invest into hybrid funds where they can have gold also, silver also, and it's more dynamically managed.
Right.
Now, for somebody who manages equity funds, not dynamically managed funds, where they can go 0 to 100 between equity and debt at any point of time, how do a fund manager typically manage such kind of movements?
So I can actually give you the example of what I did in multi-cap, since I managed that fund, and it's an go anywhere fund in terms of market cap, sector, etc. Now in multi-cap, I started managing this fund in the last week of January calendar year 25. So it's just been barely a year that I've taken over this fund. In this fund, at least the portfolio that that was at the start point, the portfolio where it had a lot of high beta names, and the way markets were at least looking like to me was that we would probably need to move to a little low beta and where there is more compounding stories rather than trying to make alpha on re-rating, etc., because that didn't look like the phase that we were in, at least. So that portfolio changed materially, especially the small cap portfolio. So we were at about 30 odd percent small cap, and we're still about closer to that number. But the holdings there have completely changed. At least in the first 3 months, it changed materially, and we've been doing some tweakings even now. But then the large part of the portfolio got changed in the first 3 months, and that actually helped us. So if you look at this fund in the 6 months category, in the the all the other time frames lower than a year, we've actually beaten the benchmark in a decent way. So what I'm trying to say is that we've actually changing the portfolio to a more low beta compounding stories in a market where you had volatility coming into the high beta names. That kind of really helped us. So I'm not saying that it always helps. Obviously there can be, phases where whatever we do may not immediately give us the results, but in this case it has. So that has really helped us. So there are these strategies which as fund managers we would deploy at times as to what we think or we perceive the market is and where it might be headed. So that's what has helped us, at least
And
in this
probably your
scenario.
bottoms up approach also helps it.
Absolutely, absolutely. So I am not, as I already mentioned, I don't look at buckets in terms of market cap or sectors, and it's all bottoms up. And but one thing I clearly do bifurcate between my fund when I am trying to build the portfolio is that how much is the compounder and how much is the alpha. And at any point of time, I would want it to be 50-50. At some points, I might want it to skew in the either ways depending on where the scenario is. But a compounder bucket and complement that with an alpha bucket. And alpha for me is nothing but stocks where things have not gone right for whatever reasons. But then they are nearing that inflection point where things will start improving. And when that kind of plays out, it also helps me place some re-rating on the table. So that kind of does, my alpha bucket kind of does the heavy weight lifting in terms of return generation for my fund, and compounder kind of holds it steady in a volatile times. Where multi-cap actually was more skewed towards alpha, and that balance kind of was brought in.
So probably, as they say, foundation and then the wall.
Yeah, you might put those analogies as well.
So what you're trying to say is कि such situations can be a good opportunity to dig deeper, to go deeper into the universe.
Absolutely. So, in fact, if markets correct, or like I was saying that in 2025, where at an index level, you have seen some gains in a 1 year time frame, but then the breadth of the market has been pretty weak. Now, this actually opens up an opportunity for us for the next 3 years. If there's something which is looking really interesting enough for us to start looking at it more constructively, and maybe start building if that segment or that particular industry is doing well.
So I have an analogy to that. So we started with 60% small and mid cap allocation. We suggested our clients to have 60% allocation in small and mid cap when we started 3 years back. But starting from June 24, we started getting shaky about the valuation of a small and mid cap.
Yeah.
And we suggested them to shift it to hybrids. And it becomes very difficult to communicate to the clients that we were recommending this now, and we are recommending completely opposite 180-degree to it now.
Yeah.
And we had all kinds of discussions. Some clients relented to it, some clients were still having some doubts, but eventually in hindsight it gets proven correct. So as you rightly said, such situations can be good opportunity to have a reset,
Yeah.
or to revisit your approach.
Absolutely.
Meeta, looking at now, as we are witnessing new year to start to unfold, how should one invest the money?
Right. So I think that there's no one answer for all, because every investor will have their own different risk appetites and requirements, etc. But as I was saying, that the breadth of the market has been pretty weak, and especially in the smaller categories, the small cap category. So there are pockets of.
So let me refine my question.
Sure.
How should HNIs invest their money? So I would define HNI as somebody who doesn't require liquidity from the money, who is investing money for the long term, for cross generation kind of thing.
Right.
And let's say who will have at least 2-3 crore in financial assets.
Again, one size may not fit all, but I would still try and give you whatever I think is optimal for that category of clients. I think that one thing we have to really remember is that in the last 6 months, a lot has changed in terms of reforms, in terms of the steps that government has taken. Not only on the tax front, even what RBI has been trying to do, pumping in liquidity, easing out, the broader contours of where to lend, etc. All of those things effectively would mean that we want to see credit growth go up. We want to see our GDP, do better, and we've been doing better relatively, and we sustain that or maybe inch up slightly more higher, and in turn, all of that would mean that EPS growths will be better, and which is what the projections are for the next 2 years, at least when I look at the broader market projections. So I think that from here to next 3 years, you're actually again probably going to see what we saw in 21 to 24 in terms of EPS growth. But valuation wise, if you look at India per se today, even if I take the broader assumptions of where the Nifty EPS could be in 28, we still look little shy of 20 times or 19 and a half times or so. So in absolute terms, we are still not very, very attractive for you to kind of go all out and park yourself here for next 3 years, like probably what we were in, say, during COVID drop. But growth is definitely coming back. And particularly, there is a segment of market which has actually not done well in the last year and is actually off more than 20%, 30% of, from their peaks. So there is a segment of market which is definitely going to throw up a lot of opportunities. So I would say that look at categories which have decent exposure to the small and mid cap levels. So a multi cap fund or a flexi cap fund definitely makes a very good case in point. One more thing that I would like to highlight is that if you look at Indian markets have been an underperformer this year versus the global markets. And what that has done is that while in absolute terms we may not look very attractive, but on a relative terms we've suddenly started looking very attractive. Our premium to emerging markets, which was actually as high as 90%, even higher in certain pockets in the last 2 years, has actually come off meaningfully. And now we are actually near our long-term average of closer to 70 odd percentage. So all those things are pointing out that there is money to be made in Indian markets in the next 3 years. And the more you are, broadly spread across market cap categories will be where I think one should be.
So I'm so glad you mentioned about global markets because I was about to ask that question only. In last 1 year, there has been a lot of murmur about investing outside India. You know, and like with any novel tool, people are more excited by its novelty, rather than facts. And then comes cherry picking. Cherry picking is like Indian markets are so expensive to other markets without looking at long term premium. So long term India has been at premium to other emerging markets. But nowadays people are either ignoring that fact or they are not aware of that fact and they are just talking that India is at premium, India is at premium. So two questions to it. First, do you think that premium will always stay? First, and if that stays, certainly we ought to have more money in Indian markets as compared to outside markets. Second, even if we discount this premium thing, PE, valuation, everything, do you think it makes sense for an Indian to invest in markets like Egypt, Taiwan, China, where we don't have more avenues also, where we don't have good regulatory insights, where we don't have good access to markets also? How do you look at this?
So on a first question, whether the premium will stay or not, look, I don't think that there is a risk to that premium, at least for the foreseeable future. And the reasons are very clear, right? If you look at our ranking in the global, GDP-wise ranking, we are now going to be in the top 3, right? And if you look at this number, a decade back, we were significantly lower. We're in the 7th or 8th rank.
Yes.
Right? So we've been increasingly coming up on that ladder, and we are now going to be in the top 3 very soon. So clearly we are growing faster. That tells you that. And even if you look at our neighboring countries, which are also emerging in many ways, we are fast pacing them also on the growth. So I think that our growth premium will definitely be there because we are growing faster. Second is if you look at our fiscal discipline, look at the countries, I mean, globally, all the economies actually what they did to their balance sheet during the COVID phase. And look at us. We have been very tight on our fiscal discipline versus any other geographies, any other economies in the world. So we've proven that we can grow faster even in times like, trying times like COVID. We have maintained our fiscal discipline, and we have now kind of found a new lever of growth, like the creating India as a manufacturing hub, or the China plus one that we've been hearing about for the last few years. I think that our country has definitely realized a lot of potential on those aspects as well, a part of the already things that we've been doing in terms of a service-led growth or our consumption-led economy, etc. So I think that there are many more levers which are getting added actually to ensure that this growth number looks better as we go ahead in future as well. So I think there are multiple reasons why India should not trade at. I mean, I would be very surprised if
It happens
even if it
otherwise.
comes off meaningfully. Forget about being at premium or no. So that's on the premium part. Second is whether an Indian investor today should look at outside India. I think that we as a house are more India specific. I mean, we invest only in India, so it's slightly difficult for me to call out which geography, etc. But I think that we have enough potential in India, within India itself, for an investor to actually make decent amount of wealth creation as you go into future. In fact, I would say that if and we have a lot of youth in the country, which is to our positive. Today, if there is a person who's entering the working age and starting to earn money, and is able to invest, if it's able to park a small amount also into equities in some form, I think that it's the best time to be there, because we are seeing our growth rates, sustaining the higher number versus our peer set. We are seeing a lot of these levers playing out for us, and there are still so many newer areas like the startup age that we're now seeing into the listed space, new platform companies which are coming,
IPOs.
new IPOs, more than IPOs, new industries which are getting, which are emerging. So there are so many ways for one to do that wealth creation as you go along. And this may not be true, 2 decades later, because the 2 decade later, when someone is entering that working age population, we would have probably already reached there to some extent, and the growth rates may not be as high as they are today. So from here to maybe next 10, 20 years, I think it's the best time to be here. So I would say that whether you go outside or no, a decent part of your allocation has to be in India.
So, Meeta, you made such a beautiful point. I will remember it for very foreseeable, future, which was about our neighboring countries. That historically, culturally, even religiously, we are same people.
Yeah.
They're smaller than us, so being much smaller than us, ideally speaking, they should have higher growth rate. But still, we are the ones who are having much higher growth rates. Now, I understand that you want to excuse saying that, at a fund house level, you don't go outside India. But let's talk about as an investor. We both are investors in our personal capacity also. Do you find investing outside India convincing? And I'll tell you my views on the same. So I look at outside India in 2-3 buckets. One is America, the other is Europe, then China, then Southeast Asia, and then everything else. Now, America we can discuss separately, but Europe, probably GDP growth rate of 1-2%. China, last 25 years annualized returns of 1.5%. Southeast Asia, you don't have much tools to invest there. Regulatory wise, they are not as strong as we are, and same for other markets also. On top of that, even in dollar terms, our market returns have been one of the best.
Yeah.
For a long term basis. So, taking these things in view, and on top of that, logistic issues, you have to send money by LRS. Now, gift city people are citing, but still, it's very, infant. What do you think that apart from the novelty factor, there can be other reasons also for investing outside India?
So, one thing that I would like to correct is that we have enabled few of our schemes for overseas investment, but because of the regulatory restrictions, we are not able to invest. But had that not been there, I would have definitely parked some money, at least in my digital fund, which is a more sectoral fund,
FANG.
into some of the US names at some point. So I would say that completely shutting off, at least if I'm enabled, may not be the right thing. Right now we can't because of the regulatory aspect. So I would say that yes, there can be some pockets, but I would still say that a large part of allocation is for
Has to
India
be in
and will
India
has to
only.
be in India.
Thank you, Meeta. Thanks for joining us. I really loved talking to you. The kind of insights that you shared were very intellectual, were very insightful. Thanks for coming on the show.
Thank you so much, Ankit. Pleasure having this conversation with you.
If you have any other topic in mind which you would like us to discuss with our fund managers, do mention in the comment. Or if you want to talk to any specific fund manager also, please talk to in comments. We'll be very happy to help you out on the same. Thank you.